In September 2008, the fourth largest investment bank in the United States had survived the Civil War, 2 world wars, the Great Depression, and the crash of 1929. It did not survive the weekend of September 13. Lehman Brothers had existed for 164 years. It was gone by Monday morning. But this is not a story about one bank making one mistake. It is a story about what happens when thousands of rational agents, each making locally correct decisions, collectively build a system that none of them can see, and none of them can stop. In March 2008, 6 months before Lehman collapsed, the Federal Reserve had arranged the rescue of Bear Stearns. J.P. Morgan Chase acquired Bear for $10 a share, a firm that had been worth $170 just 12 months earlier. The Fed provided $29 billion to absorb Bear's most toxic assets. The signal Wall Street received was clear. The government would not allow a major financial institution to fail. Richard Fuld, the CEO of Lehman Brothers, received that signal. His traders received it. His counterparties received it. The hedge funds that lent Lehman money every single night received it. And so every agent in the system continued doing what it had been doing. Fuld continued holding positions in mortgage-backed securities that were rapidly losing value. His traders continued borrowing at 30 to 40 times the firm's equity, a leverage ratio that left almost no margin for error. His risk officer, Madeline Antonchik, warned him repeatedly that the mortgage exposure was dangerous. She was later removed from her role. His accountants found a way to temporarily move $50 billion of liabilities off the balance sheet at the end of each reporting period using a mechanism called Repo 105, making Lehman's finances appear cleaner than they were. His auditors signed off on it. None of these people thought they were building toward catastrophe. Each was responding rationally to the incentives in their immediate environment. The traders were paid to generate returns. The accountants were paid to find legal structures. The CEO was paid to grow the firm. And the system had told everyone, very clearly, 6 months earlier, that the government would absorb the consequences if everything went wrong. This is the architecture of a complex adaptive system operating at the edge of collapse. Not a conspiracy. Not a failure of intelligence. A failure of feedback. In a healthy system, risk is priced into behavior. Agents who take too much risk face real consequences, and those consequences change their behavior before the damage becomes catastrophic. But the Bear Stearns rescue had broken that feedback loop. The system had learned that the consequences of excessive risk would be absorbed by someone else. And so the risk continued to accumulate, invisibly, distributed across thousands of institutions, millions of contracts, and trillions of dollars of interconnected obligations, until the system reached a point where no single intervention could contain it. By September 2008, Lehman's stock had fallen 77% in the first 7 days of the month alone. On the night of Friday, September 12, the heads of every major Wall Street bank gathered at the Federal Reserve Bank of New York. They had 48 hours to save Lehman Brothers. 2 buyers had emerged. Bank of America was interested. So was Barclays, the British bank. But Bank of America chose Merrill Lynch instead, another firm on the edge of collapse. And Barclays could not complete the deal without shareholder approval from UK regulators. The British Financial Services Authority refused to waive the requirement. The deal died on Sunday night. At 1:45 in the morning on September 15, Lehman Brothers filed for Chapter 11 bankruptcy protection. $639 billion in assets. The largest bankruptcy in American history. Within hours, the consequences moved through the global financial system in ways that nobody had modeled and nobody had prepared for. The Reserve Primary Fund, one of the largest money market funds in the world, considered by millions of investors to be as safe as cash, announced that it had broken the dollar. Its net asset value had fallen below $1 per share because of its exposure to Lehman debt. For the first time in modern financial history, a money market fund had failed. The panic that followed was not irrational. It was the entirely rational response of thousands of agents suddenly realizing they could not trust the valuations on which the entire system depended. Banks stopped lending to each other. Credit markets froze. The commercial paper market, the mechanism by which ordinary companies borrow money for daily operations, ceased. Companies that had nothing to do with mortgages, nothing to do with Lehman Brothers, nothing to do with Wall Street, suddenly could not borrow money to make payroll. Within weeks, the United States Treasury had requested $700 billion from Congress to stabilize the financial system. The Dow Jones Industrial Average fell more than 500 points on September 15 alone, its steepest single-day decline since the reopening after September 11. Some $700 billion vanished from retirement accounts in a single day. This is what emergence looks like in a financial system. Not a single decision. Not a single bad actor. A cascade, where the interactions between thousands of individually rational choices produce an outcome that none of the individuals chose, and none of them could have predicted by looking only at their own position. The standard explanation for 2008 focuses on greed, on reckless bankers, on regulatory failure, on the specific decisions made in specific boardrooms. And those things are all real. But they are not sufficient explanations. Because the same incentive structures exist in every financial system. Greed is not unique to 2008. Regulatory gaps are not unique to 2008. Overleveraged institutions are not unique to 2008. What was unique to 2008 was the specific configuration of the system, the particular way in which mortgage risk had been sliced, repackaged, and distributed across the global financial network in instruments so complex that almost nobody could accurately value them. In a complex adaptive system, the danger is never in any single component. The danger is in the connections. Lehman Brothers was connected to money market funds. Money market funds were connected to commercial paper markets. Commercial paper markets were connected to every corporation in America that needed short-term credit. Every corporation that needed short-term credit was connected to the jobs of ordinary people who had never heard of a mortgage-backed security. When Lehman failed, the failure did not stay inside Lehman. It traveled through every connection in the network, amplifying as it moved, until it reached people who had no idea they were part of the same system. This is what makes systemic risk different from ordinary risk. Ordinary risk can be measured, modeled, and priced. Systemic risk lives in the space between the components, in the invisible architecture of dependencies that nobody drew on a diagram and nobody put in a spreadsheet. The economists who later studied the crisis found something that should have been obvious but was not. The risk in the system had not been distributed. It had been hidden. Every institution that thought it had transferred its mortgage risk to someone else had actually only moved it to a counterparty that was itself connected to the same network. The risk had not left the system. It had circulated through it, growing more concentrated and more interconnected with every transaction, until the entire network was exposed to a single point of failure. The continued assumption that housing prices would not fall nationally, simultaneously, across the United States. When that assumption broke, the system had no way to absorb the correction. It had been optimized for a world that no longer existed. After the crisis, regulators built new frameworks. Banks were required to hold more capital. Stress tests became mandatory. New monitoring systems were installed. These reforms made the specific failure of 2008 less likely to recur in precisely that form. But they did not change the fundamental architecture of a complex, interconnected financial system. They raised the height of the walls. They did not change the fact that when walls fall in a system this interconnected, the damage travels at the speed of information, which, in the age of electronic markets, means it travels everywhere, instantly, all at once. The question 2008 asks is not who was greedy and who was reckless. The question 2008 asks is harder. It is this. In a system this complex, where the risk is distributed, the connections are invisible, and the feedback loops are broken, who is responsible for what nobody can see? And if nobody can see it, can anyone stop it?